Okay, so hi everyone, my name is Marian. Today I want to introduce the avoiding debt and credit management. So firstly, what is debt? Debt is a financial obligation that must be repaid, typically involving interest and repayment period, which is the money you owe to others. There are two types of debt. The first one is good debt, which is an investment for the future. It can increase your future wealth or value, but it is not entirely risk free. It still requires careful planning. For example, loans for education and mortgage. The other type is bad debt, which is high interest and necessary spending. It does not improve your financial situation. It often carries a high APR, for example, payday loans, and buying a luxury bag with a credit card. So, what is APR? APR is the annual percentage rate, the annual cost of borrowing money, interest rate and fees or other costs charged by the lender. It depends on the loan length. Two loans have the same interest rate. The one with a higher APR is more expensive because it includes extra fees. So the APR is the true cost of borrowing money each year. Dangers of too much debt. There are 4 points. The first one is high interest rate. The total amount you end up paying will exceed the amount you borrowed. Lower credit score. Missing or delaying payments can damage your credit rating. Limited financial freedom. Future savings, investments, or borrowing become more difficult. And the last one is the emotional stress of yourself. Constant worry about payments can impact mental health. Too much debt will lead to compound interest. Compound interest make debt grow faster. So there are two formula. The first one is simple interest, which is the principal multiply interest rate multiply times in years. The compound interest, we can see it is more complex than the simple interest. The N means number of times interest is compounded per year. So how to avoid that? Firstly, create a budget. Plan your income and expenses. Track spending to understand where your money goes. 3 steps to create a budget: record, categorize, and set limits. Set limits can based on the 50-30-20 rules, which is 50% maximum into necessaries, 30% wants, and 20% minimum into saving. And there are a few other points. Avoid impulse purchases. Build an emergency fund, which is save money for unexpected expenses. Only borrow what you can afford to repay. Do not take on debt beyond what your income can handle. And the most important point is pay bills on time. Avoid late fees and protect your credit score. So, what is credit? Credit is the ability to borrow money and pay it back later, based on trust that you will repay what you owe. Credit history determines future borrowing costs and eligibility for loans. For example, banks offer favorable loan rates to those with strong credit. Good credit can build financial stability, good credit score, and future opportunities. So there are some credit management tips I want to mention. Pay your credit card balance in full, which is settle the entire amount each month to avoid interest charges. Review your credit report regularly. Check for errors that could lower your credit score. Avoid opening too many new accounts. Each new application temporarily lowers your score. So, how to build a good credit? Use student cards or secured credit cards. Make small purchases and repay on time. Demonstrate responsible borrowing habits. Old accounts show long-term reliability. And the most important point is timely payment. It's one of the most important factors. What to do if you are in debt? So, prioritize debt repayment. Two common debt repayment strategies. The first one is avalanche method. Pay off high interest debt first. And also the other method is snowball method. Pay off smaller debt first for motivation. And contact creditors to negotiate payment plans. Consider credit counseling services. Avoid taking on more loans. The minimum payment trap, which is paying only the minimum balance, leads to huge long-term interest costs. So, in conclusion, wise management of credit and debt will lead financial freedom and peace of mind. Develop and stick to a debt repayment plan, include a budget and emergency fund, make smart decisions. Avoiding unnecessary debt helps us feel focused on future goals. So, control your money, do not let it control you. That's all. Thank you.